Hello, Accounting 203 and 500A students. This is Professor Hassey. This is our Week 7 introduction video for our Introduction to Accounting class. This week we're going to talk about fixed assets and their depreciation and how to calculate depreciation. We're going to talk about liabilities, turning accounts payable into notes payable, kind of like the opposite of what we discussed last week about receivables. And we're going to talk about Chapter 13, which is corporate accounting. What is different from recording ownership in equity in corporate accounting? Up to this point in our class, we've been dealing mainly with sole ownership companies, where there's just capital. Now we're going to have retained earnings. We're going to have common stock. We're going to have preferred stock. How do we account for those types of accounting issues? We'll now discuss in Chapter 13. Also, we'll do a brief review of the midterm examination. The grades have been posted. You all did excellent. I was very pleased with your performance. The solutions are posted to Blackboard, but many of you do not have to look at the solutions. You did so well on the examination, so congratulations. And now we begin the second part of our course. There'll be a quiz this week, due next Sunday. I'll give it to you tomorrow night after class. A quiz on chapters 8, 9, and 10 on our discussions. But before we finish our introduction video, let's take a look at an introduction to Chapter 13.
In this exercise, we will see how to journalize issuance of common stock and preferred stock and purchase of treasury stock. Common stock may be either par value or no par value. Par value stock is capital stock that has been assigned a value per share in the corporate charter. No par value stock is capital stock that has not been assigned a value in the corporate charter. Some companies issue no par stock with a stated value. For accounting purposes, the stated value is treated in the same way as the par value. The Stockholders Equity section of a corporation's balance sheet includes paid-in capital and retained earnings. Paid-in capital or contributed capital is the amount that stockholders pay to the corporation in exchange for shares of ownership. Retained earnings is the earned capital held for future use in the business. To record the issuance of common stock for cash, the par value of the shares is credited to common stock, and the portion of the proceeds that is above or below par value is recorded in a separate paid-in capital account. When no par common stock has a stated value, the entries are similar to those for par value stock. When no par common stock does not have a stated value, the entire proceeds from the issue are credited to common stock. Preferred stock has contractual provisions that give it preference or priority over common stock in relation to dividends and assets in the event of liquidation. However, they sometimes do not have voting rights. Like common stock, preferred stock is issued for cash or for non-cash consideration. The entries for these transactions are similar to the entries for common stock. Treasury stock is a corporation's own stock that has been reacquired by the corporation and is being held for future use. The purchase of treasury stock is generally accounted for by the cost method. Under the cost method, treasury stock is increased by debiting it for the price paid to reacquire the shares, and treasury stock is decreased by the same amount when the shares are sold later. Let us now look at an illustration to see how to journalize issuance of common stock and preferred stock and purchase of treasury stock. Transactions related to issuance of stocks for Rooster Corporation have been provided. On August 10th, the company issued 50,000 shares of $1 par value common stock for cash of $200,000. To record this, cash will be increased by debiting it for the amount received of $200,000. Common stock will be credited for the par value of the stock. By multiplying 50,000 shares by $1 per value, the par value of the stock is $50,000. Also, paid-in capital in excess of par value of common stock will be credited for $150,000, the portion of the proceed in excess of par value. On September 20th, the company issued 5,000 shares of $100 par value preferred stock for cash at $110 per share. The accounting for this will be the same as that of the issuance of common stock. First, cash will be increased by debiting it for the amount received of $550,000, calculated as 5,000 shares times $110 per share. Preferred stock will be credited for the par value of the stock of $500,000. This is calculated by multiplying 5,000 shares by $100 par value. Paid-in capital in excess of par value of preferred stock will be credited for the difference of $50,000. On November 28th, the company purchased 3,000 shares of Treasury Stock for $12,000. The purchase of Treasury Stock is generally accounted for by the cost method. Under the cost method, Treasury Stock is increased by debiting it for the price paid to reacquire the shares. Thus, to record the purchase of Treasury Stock will be increased by debiting it for $12,000, the price paid to reacquire the shares. Cash will be decreased by crediting it for $12,000.
Okay, that was a good introduction to Chapter 13. We'll talk more about that tomorrow night and look at a couple of problems from each of the chapters 10, 11, and 13. So thank you, everybody. Enjoy the rest of your weekend. Again, congratulations on great work in the midterm examination, and we'll see you all tomorrow night online at 6 o'clock. See you then. Bye-bye.